If you're looking to buy rental properties and scale and grow a real estate portfolio while using none of your own money and creating financial freedom for yourself, this is by far one of the most powerful strategies that you can utilize. In this video, I'm going to be teaching you how we use private lenders to execute the BRRRR strategy and how you can do this for yourself, create long-term success in real estate investing, because that's what we're all about. So first and foremost, if you're new to real estate or you just need a refresher, let's talk about what the BRRRR method is. The BRRRR method is BRRRR, which stands for buy. You're buying a piece of real estate. You're going to renovate that piece of real estate to make it livable and then get it performing. You're going to rent this piece of real estate. Then you're going to refinance this piece of real estate with a different lender that's going to come in and pay off your private lender. And then you are going to repeat this process as many times as you possibly can so you are hitting your goals and you're creating financial freedom. We prefer, and I encourage you to use private lenders to execute the purchase and the renovation of the property that you're buying that you're gonna eventually refinance. The reason you want to utilize private lenders is they're far easier to work with than a financial institution like a bank or a hard money lender, and they're going to scrutinize you way less. There's actually less paperwork. You're able to move more fluidly because you are building a relationship with this private lender. You have a relationship with this private lender. Everybody makes money when you do this the right way, and it's so much better to do business with somebody that you have a relationship with than a financial institution. Step one at executing the BRRRR method while using private lenders is all about buying the right deal. Like they say in real estate, you make your money when you buy, and that couldn't be further from the truth. That is absolutely essential that you are buying real estate, number one, in the right geography. So we want to focus on affordable housing and affordable real estate. This way you can actually get this real estate performing and create a positive cash flow. I'm going to touch on the affordability aspect. You also want to make sure that where this property is located is safe. It's got to be somewhat desirable here. If somebody's going to rent this property, they certainly are going to be less inclined to want to live in some type of war zone. So you want to be in areas that are safe, that are also affordable. This way you can actually create cash flow. And when you're buying the properties, not only does it need to be in a safe location, in affordable housing, but you want to make sure you're buying a good deal. And I'm going to suggest, and write this down, or make sure you're taking notes here. This is very important. You want to be all in to this particular property. All in, meaning the purchase price and the rehab amount should not exceed 75% of the after repair value of the property. You're going to hear me talk about this particular formula in many videos, but it is a wonderful, excellent rule of thumb to stick to. You want to be as far below 75% all in of the after repair value as you possibly can. So let me just give you a quick example. If the after repair value of this property is $200,000, you want to make sure that your purchase price and your rehab budget does not exceed 75% of $200,000 or $150,000. This is going to be essential when you get to the refinancing aspect of the BRRRR equation, because most lenders who are going to do this refinance and pay back your private lender that gave you the money to purchase and rehab the property, most of these refinance lenders do not want to lend more than 80%, 75 or 80% of the after repair value. So you have to make sure that when you're buying and renovating this property, you're not higher than 75 or 80%, or it could lead to you having to bring money to the table when you eventually refinance this property. We want to do the opposite. When we refinance this property, we want to be getting money back. That is one of the biggest benefits to doing a BRRRR transaction, is you can actually make money when you refinance this property, and it's tax-free money. I dive deep onto the refinancing and the type of financing that we use for refinancing, but for now, just make sure when you're buying the right deal, number one, you're in a geography that provides safe and affordable housing. And number two, you're not dealing with a property, you're not paying too much for a property. You have to be all in for 75% of the after repair value or less. And when it comes to after repair values, I'll just touch on this. I like to play in properties valued at about $135,000 to about $300,000. What I have noticed is once you get above the $300,000 valuation, it's sometimes harder to find renters who are willing to pay enough for that particular property that's going to cover your financing. Because remember, once you're above 300,000, 350, 400, you're having to borrow so much money to play in that space that the cost of your financing typically is going to exceed what you can collect in rent. So when you are doing this, make sure you're sticking to affordable housing so you can be in a positive cash flow situation. This way, the cost of your financing, your monthly payments on this refi loan are not exceeding what you can realistically collect in rent. The loan structure with your private lender is very important, and you want to set this up so you have interest-only monthly payments. And let's just pretend you're borrowing from a private lender. Remember, for the purchase and the rehab, a $150,000 loan. Remember, the property's worth $200,000, so you're borrowing $150,000. That's all the money that you need for the purchase and the rehab. And let's just pretend that you're paying 12% to this lender. Well, 12% is 1% per month. It's going to be $1,500 per month that you're going to pay to this private lender, and that should light a fire under you. You got to get moving on this thing. Time is key. You don't want to leave this note in place for 6 months or 12 months. You really want to execute this plan within 3 months or less. You don't want to be taking on more than you can chew. The way you're going to structure your financing with the private lender is typically a short-term duration type of arrangement here. Note where you're going to set it up really 6 months should be all the time that you need to buy and renovate this property. If you're doing this the way that I teach you how to do it, you don't want to be taking on these huge rehab projects and things that are going to take too much time. Time is not on your side. And typically what you want to do is pay interest-only monthly payments to the private lender. So back to our example, let's pretend this property after it's fixed up is worth $200,000, and let's say you're all in for 75%. So you're going to borrow from a private lender $150,000 to purchase and rehab this property. Well, you're going to want to pay an interest-only monthly payment. If your interest rate is 12%, we pay a lot of real estate, or we pay a lot of private lenders 12% on their money. That's 1% a month, so $150,000 times 12% divided by 12, or another way to look at it is $150,000 times 1% is your monthly payment of $1,500 per month, and then you're going to pay that monthly payment. So that's your incentive right there. I mean, you're negative cash flow on this thing. You got to hurry up, get it rented out, get it fixed up, get it rented out, and then get it refinanced. It's going to lower your cost of money. It's going to lower your monthly payment substantially, but I prefer to make monthly payments on my BRRRR transactions rather than having an accrued note. And I do other videos about the difference between a monthly payment note versus an accrued note, but I want to make monthly payments because I don't want my private lender's balance to just continue to grow. If I wasn't making monthly payments and the interest is just building up until the end when I pay it all, that could put me in a negative cash flow situation, or a negative situation where when the lender refinances me, I might be bringing money to the table. So I don't want my balance to change with the private lender. So I'm comfortable, I'm signing up for this deal where I'm going to pay $1,500 per month, but that is my incentive to get this thing in motion, get this thing performing so I can successfully refinance this property, pay back my private lender. So in a nutshell, remember, you want to be all in 75%, and then you want to set it up so you're maybe 6 months max. You really don't want these things going on that long. You should be able to execute this strategy in 3 months or less, and then you're going to pay monthly payments to your lender, and this way You can get this thing, get all the money that you need from the private lender to buy it and fix it up, pay that monthly payment to your lender, and then get this thing refinanced as soon as humanly possible. I want to touch on the rehab or the construction. I don't want you guys taking on too big of rehab projects. Number one, there's too much risk. You're tying up too much capital to take on big construction projects, and then it takes too much time. I've seen so many investors in us, in our own portfolio building, in our own career, we take on these big rehabs. Next thing you know, it's taking 6 to 12 months to finish this project. Meanwhile, we're paying these high interest payments every single month. We're losing money every single month. Stick to very basic rehabs and construction. This means you have to borrow less money. I don't want you guys taking on huge additions here and replumbing the whole house, re-electrical the whole house, rewire everything. That's too much. Stick to basic remodels. This way you don't have to borrow so much to get this property fixed up, but most importantly, you're able to work quickly to get this thing performing. Because remember, you got to get it renovated so you could get this property rented out and start collecting money on this thing as soon as possible. And then you could refinance the property. So if you're taking too long and taking on these giant rehab projects, it's going to affect your time. It's going to affect your cash flow. And I'm going to advise that you just stick to basic rehabs and keep it simple. Next up, you're going to get this property rented out. And again, you want to get this property rented out as fast as possible because you're making a monthly payment to your private lender. So you got to start collecting this money. A general rule of thumb when it comes to renting a property out, if you want to work with a property manager, make sure the property manager is doing some basic screening here for the person who's going to be moving in the property. But just a few rules of thumb is, number one, we like to see that this renter or tenant is making or bringing in at least 3 times the monthly rent with their monthly income. So if the rent was $1,000 a month, we want to see they're making at least $3,000 a month. 3x is just a good rule of thumb. Also, we're not really interested in working with tenants that have previous violent felonies, violent individuals, or tenants that previously had evictions, right? I'm personally not that concerned about bad credit, if it came from a car that they might have gotten repossessed or even a bankruptcy, but the violent felonies thing, not enough income, and then previous, if they screwed over previous landlords, I'm probably going to stay away from that particular applicant and find a more qualified person to rent the house. Next up, you got this property fixed up and rented out to a qualified resident. You got to get this property refinanced. You're going to do this through either a local bank or what is called a DSCR lender. That stands for Debt Service Coverage Ratio, and I can cover that in more detail in other videos. But this is the lender that's going to be coming in and typically giving you now a 30-year mortgage. They're going to come in with the new money that you're going to leave in place. This is what is called permanent financing. Of course, it's not permanent, but it's long-term financing that you're going to have in place. And when this refinance lender comes in, they're going to pay back your private lender so they get all of their money paid back. And then, of course, the next part is you're going to hit up that private lender to do another one. But during this refinance, just make sure that the lender that you're working with doesn't have any seasoning requirements. This is a biggie. So some of these lenders who will do the refinance for you, they want to see a seasoning period or basically an ownership period of 6 months. That's not going to serve you. So if this refinance lender wants you or requires you to own this property for 6 months before they're willing to do the refinance, that's not going to be a good lender for you. You want to work with a lender who will allow you to refinance this thing as soon as it's performing. Sometimes you could find a lender with no seasoning, meaning no minimum time of ownership, and some of these lenders will actually allow you to refinance before the property is even rented. That would be a good one to consider because remember, time is everything. So if you could find a lender who's going to refinance this property as fast as possible with no seasoning requirements, and they can get this refinance done, start working with this lender immediately, by the way. As soon as you close on the house, you should be working with this refinance lender. This way, as soon as you get the property in a position where the lender is comfortable doing the refinance, you can do it as fast as possible. That is key. You want your private lender paid back as fast as possible. You want to get out from under these expensive $1,500 payments in the example that I gave earlier, and then you just want to be able to ideally cash out, meaning when this refinance lender comes in with money, you can pay back your private lender. If this refinance lender is willing to lend more than you're paying back your private lender, that extra money you could collect at the closing table. It's tax-free money. This is how you could do what is called a cash out refinance. But when you're doing this refinance, just make sure you could get it done as fast as humanly possible. Put yourself a 30-year loan on there. Interest rates vary, but just make sure you're producing a positive cash flow. If you can make money when you do this refinance, that's always a plus, but make sure you get that private lender paid back as fast as possible so you could move into the next R, which is repeat, where you're going to use that private lender once again to do another transaction. The most common mistakes that I see in my own career and with people that we work with is overshooting the after repair value and then underestimating the rehab costs. Be conservative when you're doing the real estate business. Be conservative with your ARVs and your valuations of what a property is going to be worth after it's fixed up, and be conservative with the construction. If you think something might need $30,000 in work, put a fudge factor in there, make it $40,000 in work. Be conservative. If you think a property might be worth $200 after it's all fixed up, maybe think 180. What happens if the appraisal, when I'm going to refinance this property, only comes in at 180? Be conservative with your estimated valuation and with your estimated rehab and construction costs. So in summary, what we are doing is finding an undervalued property that we can purchase by using a private lender who's going to fund the acquisition and the rehab. We're going to make sure we're only borrowing from that private lender to fix it up and rehab it. 75% of the after repair value or less. We're going to get this property fixed up. We're not taking on too big of rehab projects because that's going to take too long. We want to get this thing performing. We want to rent the property to a qualified individual, and we're dealing with safe and affordable housing, and we're going to get this property performing. We're going to get this property refinanced as fast as humanly possible to pay back our private lender. Now we have a 30-year loan in place after the refinance. We're collecting a positive cash flow, and then we are going to manage this property. You could manage it yourself, or you could work with a property manager, and whatever the case may be, this is how you do real estate with little to none of your own money. You used a private lender for the acquisition and the rehab. You're refinancing to pay that private lender back. They got all their money back. You now have a rental property that's performing. You can utilize that lender over and over again. So if you are a real estate investor and you're just getting started and you want to get started on the right foot and kind of be successful long term, the best way to do that is to work with other people who have already walked this path. And I'm here to let you know, myself, my business partner, we have made more mistakes than anyone I know in the real estate business. And that's what they say. Hey, knowledge is learning from your mistakes. Wisdom is learning from other people's mistakes. If you're interested in getting to know us better, consider jumping in our school community. The link is down below. We have all the paperwork that we use for our private lending deals, as well as for novations and for wholesale properties. We also do joint venture agreements with people in the school community. So if you're new and you want to get your feet wet, but you don't want to be alone on this path, we do joint ventures with people in the school community, and we'd love the opportunity to get to know you better, and you could communicate with us right there in school. So on behalf of the Cream, thank you for sticking around here today, and make sure you like, subscribe, hit the bell for notifications so you're notified every time we post a new video. My name is Dave Perichin, and I look forward to seeing you on the next video.